Hey everybody, the market's been really volatile lately, and you may be wondering, is this just a garden variety correction? Is this thing going to morph into a bear market, or do we have a full-on stock market crash on our hands? And in order to answer that, I'm going to take a little look back here in history and kind of share with you how the market works and what's happened in the past. And this is taking you all the way back to 1979, and you can see every year right here at some point throughout time, the market goes down really on average almost 14% per year. In other words, market volatility is very normal. That's around here, we call it the price you have to pay to get the wonderful long-term returns that you do. And so you can see throughout those years where the market actually ended up, but at any point in time in a 12-month calendar year here, just expect the markets to go down, sometimes significantly. So then the question is, okay, what's normal? And you can see that 94% of all years, you should expect a 5% drawdown or more. 64% of all years, you should expect a 10% pullback or more. And by the way, 10% pullback is by definition what that's called a correction. And then 40% of the time, we've had a 15% decline or more. And then 20% of the time, on average, the market goes down 26%. So by definition, a bear market is considered a 20% drawdown. And take a look at this. And this is, you can see that most of the time the market is positively advancing. It's going up. It's rewarding shareholders. It's expanding valuations. But that steady upward advance is punctuated by these just deep, steep, sometimes scary declines that when you're in the moment just doesn't feel good to go through. And so this is another little view of it where, you know, when you're going through one of these things, boy, it just doesn't feel good to go through that. And you can see to the kind of magnitude and the degree of these drawdowns here. And so the question is, should you do anything? Should you change? Should you adjust your strategy? And we would say no, and here's why. If you had remained invested for over a 30-year period, your long-term returns were darn near close to 10%. But if you miss just the single best day, that's one day in a 30-year period, your returns were reduced by 0.5% per year over 3 decades. And if you miss just the best 5 days, you decided you went to cash, you figured you'd sit on the sideline, let this thing play out, your returns were 1.5% per year less. And look at this, missing 15 days in a 30-year period. That's having one bad day every 2 years and making a bad decision. Your returns were reduced by 3.5% per year. And if you missed 25 days, so less than 1 day per year in 3 decades, your returns were cut in half. So you can see that if you swing and you miss, the results can be devastating, and it's not worth the risk to panic and make a bad decision. But if you're sitting there and you're like, but this just doesn't feel right, and the tariffs, and we don't like the volatility, and this time it's different. Look, there's always a reason to hit the panic button. And what the average investor does is they pull money out of their investments, and the money flows into bonds or fixed income. That's what the average person does, and it's not the right decision. But we're here to remind you that there's always a reason to panic. I mean, take a look at, going back to 1970, interest rates are above 9%. We're in the Vietnam War. In the 70s, we had the Middle East the oil embargoes. We had Black Monday, my birthday, 1987. Market goes down 20% in a day. We had the dot-com boom and bust. We had the tech wreck then of 02. We had the mortgage meltdown of 08. We had COVID in 2020. I mean, there's always a reason to panic, and that's nothing new. And that's how it's always going to be when you invest. And I think that's what makes it a bit challenging here at times, is going through some of that emotional turmoil. Now, this is an interesting statistic. So the average investor, this is a Dalbar study, and they do this every year. and the data looks really similar every year. Over a 30-year period when studied here, S&P 500 was darn near close to 10% per year. The average investor in this time period did a little bit better than half of what the S&P did. And the reason why is because every time they got spooked, they sold. They went to cash. They missed those good days. And oftentimes the good days happen right in the middle of the bad times. And you don't want to miss that, because it's like missing the train that pulls out of the station. You never recover. And people think, oh, I'll be able to sidestep it and then get back in at the bottom. Everybody thinks that. It's not possible. So in the bond market, it's even worse. Bonds compounded at close to 6% per year. Average investor didn't even do 0.5% per year. And again, I think the data is overwhelmingly compelling that you shouldn't try to time the market, because you can't. It's impossible. Nobody can. And what you should do is you should rebalance. So make sure that you're rebalancing through this. And you should have been rebalancing in the last 3 to 5 years. You'd be selling your winners and buying into the things that were down, and you wouldn't be getting hit as hard right now. And you should also be tax loss harvesting in your taxable accounts. That's the process of selling anything that's down and replacing it with a similar security, but it's got to be different enough to avoid the wash sale rules. But tax loss harvesting can have a real advantage. It can help you participate in the recovery that's going to eventually come, but it can also give you a benefit from a tax perspective and lower your income tax bill this year, or allow you to rebalance in the future and use those losses to offset any gains. And so around here, we like to say, hey, when the market gives you lemons, you got to make lemonade, and rebalancing and tax loss harvesting are the two ways to do that. So if you have any questions or simply want to talk about this, don't hesitate to reach out. We're here for you. And, I know long-term investing is not always fun or easy, but this is why you do well over time, is moments like this. Get in touch if you want to talk. Take care.